Hi guys, and welcome to the channel. So I've been invested in the stock market for about 8 years now, and in that time I've made money, I've lost money, experiencing both market highs and lows. But I have always had confidence in my portfolio, not allowing short-term fluctuations to affect me emotionally. That's because the strategy that I use gives me confidence for the long term. And so in this video, I'm going to run through key habits that I reinforce within my investment strategy that has helped me build my portfolio over the years. Tip number one, ETFs over individual stocks. Now, this may be a controversial one, and I will start by saying you don't need to completely leave individual stocks out of your portfolio, but it is important to note that individual stock picking is extremely difficult. These banks and huge corporations that are engaged in what is known as active investing have research teams of 100 people plus that are constantly analysing the market and different investment opportunities, and even they quite frequently get it wrong. Most individual investors like you and me don't have this kind of time or manpower. And this is just one of the reasons why I would recommend, if you're not a professional investor, your portfolio should be mainly made up of ETFs. And what is an ETF, you ask? Simply put, an ETF is a collection of different assets within a single investment. For example, when you buy a single share in Apple, you own a tiny slice of the pie that is Apple. Whereas when you buy an ETF, such as the S&P 500, you now own a tiny slice of each of the different stocks held within that fund. And that is why I would personally recommend an 80-20 split leaning towards ETF that make up your portfolio. That's going to provide you with a well-diversified portfolio. It's going to reduce your concentration risk in any one industry or region, and it's going to require way less effort to maintain. One key to building good long-term investment habits is sticking to the fundamentals. A major part of this is understanding that time in the market is way more important than trying to time the market. Staying invested for the long term provides you the opportunity for even small gains to snowball into significant wealth through the impact of compounding growth. Another powerful strategy is dollar cost averaging. This is where you invest an amount regularly regardless of market conditions. This helps reduce the impact of market volatility and reduces the likeliness of buying your shares at higher prices. It's easy to get caught up in the hype when a stock is going crazy on social media and everyone's buying and it seems like a sure win. But these hot stocks are usually just trends. They soar when they're in the spotlight but usually crash just as hard. And many people end up losing a lot of money when the buzz dies down. Instead, focus on investing in companies or assets that you're comfortable holding for the long term during both market ups and downs. The key is investing in things that you believe in, not just chasing the latest trend. I personally would recommend setting up a monthly direct debit if you can that sends the money automatically each month without you having to think about it and then just forget about it. Don't check your portfolio every day and don't panic when the market dips. Everyone gets the urges to sell, but that's where most investors go wrong. Remember, time in the market is something you can control. Time in the market is a fool's game. If you have constructed a well-balanced and diversified portfolio, have confidence that it will bounce back given time. If you stick to these investing fundamentals and apply these habits, you can help grow wealth steadily and confidently. Remember, stay calm, stay invested, and focus on the long term. Thanks for watching.